Well, it's post-Jackson Hole. Jackson Hole is over, and now a lot of people are freaking out and fighting over what Jerome Powell actually said. Well, here I am to clear it up. First, we need to talk about FAIT, flexible average inflation targeting, which is actually becoming FIT, but it's basically the same thing without the downside. And yeah, it's supposed to be confusing. So if you don't know what any of that just was, don't worry. You can still get life insurance in as little as 5 minutes by going to mekevin.com/life. Paid sponsor of the channel. Same insurance I have. Anyway, look, here's the thing. Jerome Powell said that in 2020, they came up with a policy known as flexible average inflation targeting. What does that mean? It's basically a way of saying, hey, inflation has been really slow the last, decade. So we really want inflation to be at 2% on average. So what we're going to do is we're going to say, because inflation, let's say this is the 2% target right here. And we're running at, somewhere around here, 1.75% before COVID. What you have, there you go on screen so you can see it. What you have is inflation that's constantly undershooting. And in 2020, before COVID, the Federal Reserve wanted markets to know that the Federal Reserve was actually okay. They were sending a psychological signal saying, hey, we're okay. If we go up a little bit inflation and keep rates lower, we're actually okay with that. Because if you average this section and then average this section over here, it all kind of averages out to 2%, and we're okay with that. That's what the flexible average inflation targeting was of FAIT back in 2020. Now, Jerome Powell made it very clear that this was a big mistake after COVID because FAIT was really designed, which he's told us, it was designed for a period of time where inflation was just slightly low. FAIT was not designed to be functional during a time when inflation was skyrocketing like this, or actually probably even more, going off the chart, because we're up here at 9% inflation, right? You can't really average that. So at that point, we ended up seeing the death of flexible average inflation targeting. And Powell said, no. We're not averaging inflation at 9%. It's way higher than where we sit at the 2%. Oops, let's go ahead and add that back in. It's way higher than that 2% from where we sit. So if, we're over here at 9% and we need to get all the way down to 2%, then obviously what we're going to do is we're just going to hike rates to pressure the market down or to pressure inflation down. And we're going to make sure everybody knows from an inflation psychology point of view that it is not okay to assume that we will not do everything in our power to get inflation back down. Okay, that's basically the death of flexible average inflation targeting. So you went from FAIT. Let's write this down to keep track of this, because I understand this is complicated, but it's really important to understand this. You'll see where we're going. Oh man, come on, buddy. All right, stupid iPad. There we go. All right, so we went from FAIT to no FAIT. Okay, we lost FAIT for a brief period of time there. Okay, what do we have now? Okay, what we have now is basically FIT, and it's flexible inflation targeting. What they're doing is they're saying, hey, look, because tariffs have been applied in such an abnormal manner, where typically, your tariff rate goes like this. You have tariffs at this level, you apply tariffs, and then they sit at that level. That's typically what you have. You have the stair stepper. Instead, what we got was, we got this, and then we got down on the pause, then we got a lot of this. It's been a disaster in terms of the tariff application, but tariffs are actually still lower than what the Federal Reserve had planned on or expected. See, the Federal Reserve was pricing in a base case of an average of about 18.2% in trade-weighted tariffs. we're averaging out to somewhere between 16 to 17%, somewhere in that range. And this is slightly below what the Federal Reserve has already been pricing in. So they're functionally anticipating or functionally anticipated tariffs to settle around this level, even during liberation time. So what they're saying is, hey, we're going to be flexible with our targeting of inflation. We're not going to try to average it out. And the reason he's doing that is he wants to say, like, if inflation goes up to 4 or 5%, we will absolutely raise rates. We're not going to average out a 4.5% level. But by being flexible with our targeting around 2%, we're not going to overreact to these tariffs, which over time will be a one-time price effect. So even though that time span is going to be wider, it's not going to be as quick as tariffs traditionally are with their price impact. They will probably end up being transitory. That's what Powell is telling us. So why does that matter? It matters because Powell is basically telling you, hey, I am willing to back off this fight against tariff inflation for the time being. Why does that matter? Because it's bullish for the market. It basically guarantees us a 50 basis point cut. So you guarantee a 50, or sorry, guarantee a 50 basis. You guarantee a 25 basis point cut, right? So you guarantee 25. Because Jerome Powell recognizes that the jobs data we've gotten of 3 months in a row of 35-ish thousand jobs is bad. So he recognizes we're slightly above where we need to be. And in order to get slightly back down, we're going to go for the 25 basis point cut. This is why markets are pricing in a 25 basis point cut now with an 83% chance, and 2 cuts by the end of the year are fully priced in. Now, what can change all of this? Well, obviously, Powell is reacting to dovish jobs data that says, hey, we need to be careful of the downside risks here to the economy. What if jobs fully roll over? That's possible. And in that case, the jobs report that comes out on September 5th could be critical for determining a 50 basis point cut. In my opinion, we're really likely to get a 25. And because we're likely to get a 25, and Kevin Hassett this morning told us that the White House was grateful that Powell's speech was sound, which is the first time we've heard them say something nice about Powell like all year. It's a sign that Donald Trump is actually probably going to back off the idea of firing Lisa Cook, back off the idea of filing a lawsuit against Jerome Powell. We're going to see less pressure from the White House on the Fed, which means less worries about central bank independence. And we can focus a little bit more on things like maybe the 10-year Treasury coming down, which would be great. 10-year Treasury has relaxed a little bit, but we're still at 4.29. So we're still a little bit on the elevated side. We'd like to see that get under 4%, especially to really boost real estate. And you'll see that happen if we get a weak jobs report again here. We're expecting an 85,000 payrolls number on September 5th. Outside of NVIDIA this Wednesday, next Friday is your biggest catalyst. So, broadly, in order to be bearish right now, you really have to be betting against NVIDIA, which for the last 2.5 years has just been a bad trade. This is why this morning in the Meet Kevin Alpha report, I said I'm leaning bullish over these next days. And I actually think we have a buy the dip opportunity, and you have an easy choice to go for Friday calls on things like, potentially Palantir once we bounce at the 151 level, which is exactly what we did, or we recover on the Qs, which is, what's happening right now. So these are the things that we talk about in the Alpha report every morning. But what I'd like to bring your attention to now is I want you to see RoboBay, because I don't want you to take it don't just take my word for this, okay? It's not just me who's saying this about the flexible average inflation targeting. It's also Rabobank and other institutions. And this is important because there's been so much confusion about what Powell actually said and what he means. So this is where you can see here, what followed FAIT was the largest outburst in inflation since the 80s. Now, again, why did that happen? That didn't happen because Powell had FAIT. It happened because of massive money printing, because of COVID. So obviously, FAIT looks dumb. It looks like it's a bad policy. And that's why Powell is slightly redefining what their framework is. They're going from flexible average inflation targeting to just flexible inflation targeting. And you could see that right here, where here, second, they return to a framework of flexible inflation targeting without the averaging and eliminating the makeup strategy, whatever. Okay, so what does this mean? Again, what this means is Powell is willing to go back to calling inflation transitory. Now, I'm somewhat surprised by that, as you probably should be as well. Okay, I don't know why it does that. Standby on. Okay, that's very weird. Apparently, I can't add text, but that's okay. I'll figure it out. I'll handwrite it then. Yeah, it just goes black when I try to do that. Huh, that's quite odd. My iPad's it's just having a bad day. It's okay. I was just going to write that they're basically here saying that they're back to inflation is transitory. Okay. Now that's actually really bullish. So that's one of the reasons why I'm quite bullish right now in the short term on the Fed. So if you ask me, what do I think about the Fed? I think bullish. If you ask me, what do I think about the labor market? I think bearish. But I'm really not worried about longer term inflation. In fact, if you've been watching the channel, and I understand this takes a unique set of like context building here, but if you've been watching the channel, I've been very clear that I think inflation will prove to be transitory, but I'm worried that Powell is going to make a mistake, right? Think about that for a moment. Like try to put that together. I think inflation is going to be transitory because of, tariffs or whatever. But I think Powell is going to make a mistake thinking that it's not going to be transitory because once bitten, twice shy. And then he's going to stay too tight. So think about that, okay? So we write that down. Kevin is worried about, Fed equals second wave, and then they're too tight, and then they end up being too late, and then we end up with recession, right? That's the concern. But that's not what we got, okay? That's not what we got. What we actually got was a Powell that said, you know what? We're going to have flexibility with this. Not only are we going to have flexibility on this whole second wave worry, what we're going to do is we're going to say, hey, guys, listen, these tariffs are going to be transitory. It's going to take longer for them to show up, but they'll end up being transitory. We have to balance the labor market. We had really slow labor market readings over the last 3 months. So we're going to set up for 25 BP. So we get flexible on inflation and we get the 25 setup, right? This reduces the odds of Powell being too late, and it therefore reduces the odds of recession. Now, so again, this is why this makes Kevin bullish Fed. What's the remaining problem? The only remaining problem is the job market. Will the job market fall off a cliff? If the job market falls off a cliff, okay? So this is quite binary, frankly. So one option is cliff, okay? If we fall off a cliff, it's recession, it's game over. You're going to see leveraged ETFs get smoked, margin calls galore, risk assets sell off, the AI bubble pops, valuations collapse, everything goes to hell. This is your fear-monger, worst-case freaking scenario. That job market goes, it's not rate cuts that saved the job market anymore. It's massive money printing. But you can't print enough damn money. Why can't you print enough damn money? Because of AI. AI keeps the boot on the neck of the jobs market for years longer, and we end up with a 10-year poopy doopy. It's gonna suck big ones, okay? It's gonna suck. Alternatively, this is the best case scenario. We soft land, okay? So we end up with really bad jobs data right here. Okay. We call it the tariff job lull. Job lull. Okay. And that's 35K on average for 3 months. We get the tariff low and then we start recovering. We get back to hiring and we get back to 100K on a 3-month trend. That right there is the definition of your bullish soft landing. If we could stick the next 3 months, it's bullish right here. You want that 3-month average to get back to 100K. That is the most bullish thing you could pull off right there. Again, a cliff on jobs, there's nothing the Fed could do. If we get back on jobs and you've got Powell bringing back flexible inflation targeting, he's basically bringing it back with different branding. It's like the same clothing, but it has different branding because he's just telling you, like, we're not going to make a stupid mistake and assume inflation is transitory and when inflation is 9%. That's the loss of the average. The reason they took the average out was because they ignored inflation when it was 9% and they realized they'd made a big oopsie doopsies. Okay? So they got rid of that to rebrand it to make it feel different. But that has created a lot of confusion in this market. A lot of people, people have been messaging me, DMing me, emailing me. They're like, Kevin, but Kevin, they got rid of FAIT. And I'm like, no, they didn't get rid of FAIT. They brought FAIT back. They just rebranded it. It's bullish. Like, I want to shake you by the shoulders and go, this is bullish, the Fed. The Fed is finally realizing they don't want to be too late. This is a good thing. It's a great thing, actually. That doesn't mean we won't go into a recession because it could already be too late, right? So this is where, like, I'm purposely saying these things very, very clearly because there are a lot of people who are like, wait, Kevin, I thought you were a bear and we're going into a recession. How could you be bullish the Fed? Because there are different parts of a complex economy. I am bullish that the Fed is now doing the right thing and that they will give us 25. And if we get a weak jobs report, we'll get a 50. If we get a very weak jobs report, we're going to have a big sell-off and it's going to suck. And you're going to want trailing stop limits. That's what you personally do. If we get if we get a really bad jobs report, set trailing stop limits to get you out of margin. Please, please, please do not make the mistakes that I have made where you hold on for dear life on margin. Okay, now, like, it's fine. That was all, like, a long, long time ago. I'm just saying, like, if you could learn from that, the way to learn from that is have a trailing stop. Okay, it just enough to get you out of margin. It's a good thing. Now, after that, obviously, you could just hold on. Just know if we do go into a recession, it could be a decade. But that's okay. Like, I'm okay with that. Like, frankly, so should you. The vast majority of the people who watch this channel are between 25 and 45. That's probably like 80% of you, okay? All of those of you between 25 and 45, you should be like, you're right, Kevin. Give me a year. Give me a year to go shopping. Give me a year where I can work hard and buy the dip and grow the portfolio, increase my share exposure, right? Whether it's real estate or stocks or both, doesn't matter. Obviously that sucks if you're, like in your 70s and you're retired. Somebody here on the vertical stream says, they're 62. What's up, be nice? You got a decade too, right? Like you could still build that portfolio. Either way, like, I'm not saying, like, I wish a recession on people. I'm just saying if it happens, like, we're going to make the best of it, right? So, if it doesn't happen and we pull off the soft land here, okay, we got a green light to keep buying. And this is why we're doing Kevin's 10 buy list for the next 10 years. And so these shares that I buy will not be sold for at least 10 years. We're on stock 1, which I'll add more shares to that. We're on stock 1 out of 10. So over the next probably 8 weeks, probably on average 1 a week. Some weeks will be none, some weeks will be 2. We'll be adding 1 to that list in the course member live stream and the alpha report over about, again, probably the next 8 weeks or so. So, and that's because there is a real possibility that we do end up sticking a soft land here, and we don't have to, be concerned about this falling off a cliff. The cliff happens, just be prepared. The biggest risk on the cliff is not panic selling good companies, it's debt. And think about the debt. Options are a form of debt, just because there's a time expiration on them, and it moves as quickly as debt, basically. It's technically not a form of debt, I know. Leveraged ETFs, very dangerous. And then, of course, the not just leverage ETFs, but straight up margin. Margin is at all-time highs. Buy now, pay later is at all-time high. Leveraged ETFs are at all-time high. The amount of leverage in our system right now is insane in the financial markets. Real estate leverage is actually really low, like absurdly low real estate leverage right now. A lot of cash purchases. House hack doesn't owe a dime of bank debt. Like absurdly low leverage in real estate. And that actually is really interesting, because when we, if we do end up either soft land, this is why I think Warren Buffett's getting exposed to real estate stocks. If we soft land, it's bullish real estate because rates come down, people can leverage. Asset prices go up. If we recession, rates come down rapidly, which is bullish real estate, people can re-leverage, and it's bullish real estate asset prices. So, I've been building this real estate company, for 3 years now, in anticipation of rates coming down. It's great. Like, we don't care how long it takes, because again, we don't have bank debt, it doesn't matter. But we're patient. But we it's not a matter of if, it's a matter of when rates are coming down. They're coming down. So anyway, hopefully this adds some real clarity here on the Fed, because I know that there was a lot of confusion, and I know that there's a lot of confusion when people are literally emailing me. And they're like, Kevin, like, people will even say like mean things. They'll say things like, I thought you were smarter than that. Like, you have to be a jerk to write those words, It's like, hey, you could say, hey, I have a difference of opinion. My opinion was that Jerome Powell said this. But then to go, she got rid of, there's no flexible anything anymore. I thought you were smarter than that. And I'm like, man, who are you? Are you sometimes I think, because this has happened before, I think short sellers, they'll like try to manipulate creators' points of views to get a creator to say something about the Fed or a stock or whatever, so they can get out on their puts. I honestly think that's sometimes why, like, you'll even see bot farms on certain stocks come through, and it's all just a game to manipulate people to get stocks to move in a certain way in the short term from short sellers. So you have to be really careful about that. I always like to be, exceptionally transparent. Like, I don't have any options on individual, well, some options on bonds, but no individual stocks. And I like to be transparent. Like, if I'm talking about a company, I'm going to tell you if I own it. Like 3 weeks ago, I was talking a lot about Axon, and I'm like, I'm really bullish on this company, but I don't own any of the stock, and I don't have any options on it. Like, I think it's really important to just be transparent with folks. And that just increases fairness and the way it should be. But just be aware, like, sometimes if you see bot farms in the comments that are getting voted up or whatever, remember this: it costs, how much does it cost? I think it costs, is it half a cent or 5 cents? I can't remember. It might be 5 cents. But for $1, you could buy 20 hate comments on somebody's YouTube channel for $1 if it's 5 cents. I think it is. And for, imagine how much, if you're a hedge fund, you could try to manipulate social media by buying comments for 5 cents or, likes or engagement or whatever. It's insane. So, whole brave new world we're in, I guess, huh? Anyway, hopefully that clears things up about the Federal Reserve. That's a lot of information. I hope you enjoy.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.